Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Regular listeners to the podcast would have heard me speak a fortnight ago to Dr. Shane Oliver, Chief Economist and Head of Investment Strategy at AMP. That conversation took place ahead of the inauguration of Donald Trump, and we were looking at the potential impact of the policies he'd flagged without knowing if any of them would actually be introduced. Well, now it's a very different story. A trade war has begun after the president issued an executive order for a 25% tariff on Mexico and Canada, with the exception of Canadian oil and energy products. It'll just be 10%. Canada retaliated almost immediately with its own tariffs on US goods. China faces another 10% tariff on top of existing tariffs. I wanted to follow up today with Shane for a look at the global impact of this trade war, what it means for inflation, what it might mean for interest rates locally, the impact it's going to have on us. Shane Oliver, welcome back to Fear and Greed.
Thanks, Sean. Thanks for having me.
Shane, you've been an economist for a long time, a chief economist at AMP for many years. When something like this happens, where Donald Trump comes and whacks on 25% tariffs, is that kind of exciting? It's certainly not run-of-the-mill.
It's certainly not run-of-the-mill. I guess it does create a lot of activity, and in that sense, it creates a bit of excitement as to you start wondering about where it's going to go. The only problem is, when I started my career, there was a lot of changes back then. Tariffs were being slashed. We were seeing deregulation across the board. The Aussie dollar was floated. Interest rates were freed up. There was product market deregulation, labour market deregulation, tax reform. All of that had the same level of excitement, but I thought it was all positive moves. Whereas now I worry that it's an unwinding of a lot of the positive stuff we saw decades ago back in the 80s and 90s. And so that sort of at the back of my mind makes me feel a bit negative about it because I know where this can ultimately end up, and it's not necessarily a good place. Could be a bad place. So that's why I'd rather not be going through this. But yes, waiting to see what happens can create a degree of excitement. But to be honest with you, I'd rather see something in a more positive direction.
Okay, so what do and we can only take Donald Trump at face value. They're apparently coming in almost immediately, the tariffs. Assuming that does occur, and I'm not quite sure the transmission mechanism, there's going to take some time for prices to change. But let's say it happens fairly quickly. What does that mean? Let's start with the US consumer.
Well, Donald Trump has regularly argued that he doesn't see any increase in prices, that it's the foreigner who pays the tariff, not the American consumer. But we know from basic economics that you put a tariff on to change relative prices. So the imported, the product, the docks in the US or across the Canadian-Mexican border might have been $100 worth of imports. The importer has to pay an extra $25 on that to the US government. If the retail price of that product was, say, $150, that $25 tax could be added onto that if the importer passes it through completely. Obviously, there's some debate that they may absorb some of that into their margins. The foreign producer may absorb some into their margins. And so the pass-through may not be a complete $25. But odds are a big chunk of it will get passed through. And that's the whole point of the tariff. It's designed to put up prices of imports, make them less competitive compared to homemade products in the US. And so the US consumer will pay for this one way or another. Either the imports go up in price and they have to bear that cost and pay more, or alternatively, they have to switch to higher cost domestic production wherever that exists, if it's possible, and they still end up paying more. I know Donald Trump says, no, it doesn't work that way, but if that's the case, then there's a gross inconsistency what he's saying. And to be honest with you, I think it's about as much gobbledygook as blaming the DEI for the plane crash in Washington or the LA fires. Yep. We know from history, as you put up tariffs, consumers end up paying more.
What about the response from Canada? And Mexico has indicated it's looking at putting up tariffs. This sort of trade war, is it the case where once one does it, it's sort of tit for tat, I suppose is what I'm trying to say here. And can anyone win in that? Doesn't that just lift the price rises across the board?
No, it just keeps going until one side or another gives up, or, the tariffs are at such a level that there's no more imports anyway. We saw a bit of this in the trade war in 2018 when the US started putting tariffs on China. There was a tit-for-tat move there. I think in the end, more and more goods on each side were being subject to the tariffs. In the end, of course, China ran out of imports to put more tariffs on. And then, of course, it coincided with a fall in the US share market into Christmas Eve 2018. It had almost 20% fall, and Donald Trump got nervous and pivoted towards the phase one trade deal. So ultimately, something gives, but you can go a long way before that actually happens. This time around, though, it's a lot more aggressive up front. The tariff increases back in 2018 increased the average tariff rate in the US by 1 to 2 percentage points. This time around, it's at least 6 percentage points, potentially more, because the countries involved are 45% of imports coming into the US. And the amounts being talked about are much greater, 25%, 10%, and so on, much bigger amounts than back then. So you could see a more immediate impact this time around, assuming the tariffs go through as Donald Trump is indicating.
Stay with me, Shane. We'll be back in a minute to talk about what it all means for Australia. I'm speaking with Dr. Shane Oliver from AMP. We'll get to the dollar and equities and that in a moment. Before that, the economic impact on Australia. Is there a substitution effect here that maybe some Canadians and Mexicans think, well, we're not going to sell to the US, we'll look for other markets. We're a long way away, so we're probably not going to buy Mexican cars. I get that, but that gist, could that happen?
It certainly could. There could be good things in this. We could get products from other countries that we currently don't get. It takes a while, though, for that to start happening because a lot of the infrastructure in Mexico and Canada is pointed north or, in the case of Canada, south. They'd have to change and they'd have to come via ships. So it'd take a while for all of that to work out. But the basic impact would be, there's several things going on here. Why have share markets suddenly got nervous on the back of this? I think many investors had thought, well, it's just bargaining, there'll be a deal. Now, of course, what's happened is that markets worry that, well, it won't just be these tariffs, there'll be other ones imposed down the track. So if everyone starts imposing tariffs and there's tit for tat all around the world, then it leads to a reduction in global trade. And that's where Australia ends up losing out because we are a trading nation. We're relatively open. If there's less free trade globally, that can mean less demand for our exports, of course, even if we don't have the tariffs put on us, less demand coming out of China, for example, and that, of course, would be a negative for Australia, and that's partly why share markets have gotten very nervous about it.
So what do you think share markets will do over the next little bit? We've had a dip immediately, not surprising, but kind of these things take weeks and weeks and maybe months to work out, Shane. Where do you think they end up?
Well, unfortunately, it's going to be a rough ride for a little while. If you go back to 2018, it's a similar playbook. The US share market was very strong going into 2018, just as it has been recently. Donald Trump, that time around, waited to strengthen the US economy via his tax cuts and deregulation in 2017. This time, he obviously doesn't feel the need to do that. Maybe he thinks it's already pretty strong, unemployment's already pretty low, so that's why he's moving so quickly earlier on. I think this could have a lot further to go. It is quite possible we get up one morning and we find that the tariffs have been removed because Mexico and Canada and maybe China have done what the US wants. But then by the same token, Mexico's already done a lot on the border. What more does the US want? So a lot of uncertainty around that. But markets will sort of be fretting that this will spread to semiconductors, steel, aluminium, other metals, pharmaceutical products, and so on. Tariff will be put on the EU. Maybe he'll do the general tariff on all imports that he was talking about. That may be one of the arguments he puts up for the tariff, that the end point is the tariff itself. It's not as a bargaining chip, which he sometimes refers to. It is actually to bring production back to the US and raise more revenue. If that's the case, these tariffs could be in place for a lot longer. That means less trade globally, a hit to global economic activity. I don't know how much, but it could be up to 1 percentage point off global economic activity and a potential boost to inflation globally. So it could take a while to play out. Now, in 2018, you tend to see these knee-jerk reactions each time there's a tariff announcement, then the market sort of settles down, then there's another announcement, market settles down, and so on. But by the time we got to September, October 2018, it became too much, particularly when it was combined with the Fed raising interest rates at the time. And US shares had a near 20% fall from their high in September 2018 to the low in Christmas Eve 2018. Donald Trump then got nervous, and I think one of his KPIs is he wants shares to go up more than down. He then pivoted. So maybe you'll see the same play out again. Rough ride for some time. Then, of course, you start to see some pivoting. Donald Trump starts to wind back a little bit, and then markets could go there on their merry way again. But I suspect we're in for a little bit of a volatile ride here.
Bringing it back home and interest rates, which we always do on this show, what does the Reserve Bank do next month? Because there's plenty of reasons for them to cut rates when it meets, but this sort of uncertainty doesn't help that case necessarily.
No, it doesn't. But interestingly, as we're speaking, the probability of a rate cut in February, a couple of weeks' time, has actually gone up. On Friday, it was 92, 93%. When I last looked today, it was 90. One was 98% of the look at the futures, and the so-called OIS, about 96. So it's actually gone up. And I think that shows the ambiguity here in terms of inflation. So we know that if you have these tariffs, it will be a hit to economic activity. Australia is vulnerable because it could mean less demand coming out of China. So that's a hit to demand in the economy and GDP. On inflation, it's ambiguous, and Deputy Governor Hauser did make this point last December. On the one hand, less trade globally could mean higher prices. On the other hand, less economic activity can put downwards pressure on inflation. That's why it's sort of ambiguous, and I think the money market's leaning to the view it means downwards pressure on inflation. So my view would be that unless we see Australia introducing retaliatory tariffs in response to US tariffs on our products, or we see a precipitous crash in the Aussie dollar down at 50 cents or something like that, then I think the RBA would most likely proceed with a cut. But by the same token, I don't think we should assume that we're going to see cuts at every single meeting. I think the more likely scenario is you get a cut in February, then the RBA has a pause. The next meeting in April is probably in the middle of the election campaign. The RBA would probably want to see what's the impact of the lower Aussie dollar. Is the labour market still remaining strong? And then they potentially go again in May. So what the lower Aussie dollar does, I think, is it just slows down the pace of easing in Australia. I don't think it necessarily stops the easing.
Shane, thanks for talking to Fear and Greed.
Thanks, Sean.
That was Dr. Shane Aylmer, Chief Economist and Head of Investment Strategy at AMP. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.